I guess in the beginning there was darkness. One often asks herself, what was life like before Fama and French and before CRISP and all of that? And I think the origins really started to surface in the 50s with probably Markowitz's dissertation.
Harry Markowitz's thesis here, which he got the Nobel Prize for, was the first statement of portfolio theory. And Merton Miller, who was my professor, had written a very famous paper, 1958, on capital structure.
You get Sharp, Lintner, and Mawson develop the capital asset pricing model. That's what Michael Jensen uses to measure the performance of mutual funds that existed at any time from 1945 to 1964.
Investment management and finance suddenly morphed out of a really subjective, undiscriminating capacity to introspect and understand what was going on, to a full-fledged data collecting, hypothesis testing, theory formulating line of inquiry.
I think the grounding back in the University of Chicago, always thinking about markets, thinking that markets work, and that, you know, in a competitive market that works, risk is compensated, and that's it.
It's hard to imagine a paradigm shift any more profound than what was going on at the University of Chicago, which said all this Graham and Dodd analysis of stock picking probably is not worth the cost.
I said, this is what I want to do. I want to take these ideas and apply them, because this makes so much sense. Investors will be so much better off.
So that was just kind of a natural outgrowth of the theory of efficient markets, which was applied effectively early on by Rex Sinkfield and Mac McQuown.
Rex had done a remarkable job. When he left school, he was interested in working on index funds as well, and he created the first S&P 500 index fund at American National Bank in Chicago.
On September 4th, 1973, there was $30 million of a bona fide S&P index fund. Now my partner, my future partner, David Booth, he was then at Wells Fargo in the Management Science Department.
I left Chicago and went to work for Mac McQuown at Wells Fargo. And what had happened was, when people saw all the evidence about professional money managers, the conclusion was, well, if professional money managers can't beat the market, we can at least buy the market relatively inexpensively, that is to say, an index fund.
Practitioners early on were naturally very skeptical because, not skeptical, I mean, they were absolutely hostile because we were questioning the foundations of their existence.
People even said, you know, it's un-American not to pick stocks. What's index funds are, you know, what are you doing?
When first exposed to indexing, I had this response that I think most investment professionals had, was that, oh, this is pretty lame. I mean, if you want to be average, well, I guess it's okay, but who'd want to be average?
I'll admit it wasn't exactly a groundswell. It was a new idea and is kind of a moment.
We're thinking about starting a small company index fund. And then people kind of liked the idea of that, but they weren't too sure about indexing small companies. So then I just made up the term dimensional. So the next couple of people I talked to said, we're thinking about starting a small company dimensional fund. And people seemed to really respond well to that.
David and I had stayed in touch over the years.
Rex called up and said he'd gotten wind through Richard Ennis what we were doing. And he'd been thinking about doing the same thing. And so I said, well, then we should talk.
In our conversation, we had discovered that we both had pretty much come up with the same product, almost down to the level of detail. And so he said, let's get together. And that's how it happened. We got together.
Their basic idea was that pension funds just weren't being exposed to small stocks. And there was a business opportunity just in providing them small stocks.
The idea was to, instead of pick individual stocks, you could have an index or a diverse, passive index portfolio of small cap stocks and offer that to your clients as a way of diversifying their portfolios.
It's having that kind of a collaborative framework move forward into a practicing realm. So I think it's really sort of just an extension of this University of Chicago finance culture from the 60s.
Here's a couple guys out of business school, really smart guys, honest guys, I think had the right idea. They wanted to provide investment strategies that worked, that were low cost, that were focused on, the clients.
And there's a huge influence on just thinking about how you design products, how you thought about things. You just didn't do something. You actually did something because it was rigorously proved.
It grew slowly. Over the first year and a half, there was a serious doubt about our ability to survive. We ran out of money a number of times.
It was really, it stretched, it took every kind of skill we all had to kind of pull this off.
I think anyone starting out on something like that doesn't actually know when they start that it's going to be successful.
The sales force at DFA had to go out and make the hard calls. It was not an easy thing to do. The consultants were not friendly to us in the beginning at all.
Most consultants were very biased towards active management. So it was difficult to have conversations with consultants.
What we took to really make things work is we took a lot of the academic names that we had with us.
Frankly, it added a lot of credibility in the institutional world because we went out and we said, we have this group of people from Chicago. They were all household names in the field of financial economics.
If I call up and say, Myron Scholes wants to come and talk to you about an idea, and these big funds, it was like, I called 5 big funds, institutional type funds, and they all said, sure.
It was clear that we had something that was saleable. So it was just a question of surviving over a period to cover the rather high cost of running these large passive portfolios.
The firm was founded on the notion that if we can just deliver this sort of hypothetical, academically identified small cap return, which was based on buying every single small cap stock, then we could be pretty successful.
I think one of the most significant endeavors in early dimensional days was to realize that we needed to collect enough data that we could actually carefully measure the cost of trading.
A soon-to-be Nobel laureate, a friend of the family, Myron Scholes, said, this is kind of interesting, but you'll never pull it off because these small cap stocks have some problems. They're very illiquid. When you actually try to do this in real life, you may not be able to achieve those returns because of trading costs and all that stuff.
It didn't take very long to figure out that, in fact, you could deliver the products, and the trading costs weren't killing you. So that was the first big discovery produced by the company.
This flexibility was a huge part of, first, their insight about how you ought to build a portfolio, and second, the value added that Dimensional has had through time.
No academics could ever possibly have forecast because it took practice to, it took implementation to figure out to see that this in fact could be done.
So they came with this idea, look, trading costs are important, we cannot really index, but let's develop a portfolio that is a passive portfolio, very broadly diversified that tries to capture the asset class returns.
Some people say, well, you make money from trading. We don't really make money from trading. We don't give up the costs that a lot of people do.
The reason I think we can do better at trading than our peers is not because our other people don't have as smart people, or at least some smart people, but because our environment's different. The philosophy that allows flexibility and patience to go into it and not to be beholden to a broker for research, to just pick the best solution and to not have such a strong opinion about this stock versus that stock is kind of liberating.
You can have all the great theory and quantitative techniques that are possible, but nevertheless, at the end of the day, it's sitting down and having a rational discussion, making things intuitively appealing to prospective clients that determines your success in starting a business.
David was in Chicago, and he came to my office, which was in an old building overlooking campus, and I said, here's some results that French and I are working on. I showed him on my computer. what we had come up with in the way of the differential returns of high book-to-market stocks versus low book-to-market stocks. The names value and growth didn't exist at that time. And he looked at it and said, holy smokes, he says, there's a business opportunity there. And I said, we have this risk story too that we can put to it.
The idea that value outperforms growth wasn't new. I mean, that'd been around for a long time. It may be defined differently. And of course, Fama and French did it more scientifically and, quantitatively, they really nailed these things.
Fama and French didn't invent the value effect any more than Ben Franklin invented electricity. He found a way to understand it better.
It wasn't until we realized, this is a really nice way to frame the investment process, thinking in terms of these dimensions. And it's just a very easy way to explain where your portfolio is within the framework of size and value versus growth.
For the clients, this was a new, revolutionary, interesting idea.
Made it easy to explain the value effect and the size effect, because now you had a model and you could say this is related to risk.
When Fama and French came out with their work, and I remember seeing their original work presented in the conference room in Santa Monica.
Gene was there that day to give us this lecture on this paper that he was about to release, and we sat there, like students lined up, and he was up there preaching.
The day that, we decided to launch, strategies based on the Fama French three-factor model, that changed the course of Dimensional in a way that, none of us could, I think, have anticipated.
DFA, within 1993, came out with the Fama French research, and by that time, it allowed DFA to move from being a niche institutional player to a full, complete solution firm.
What that allowed us to do in developing our strategies and developing our, clients and working with them really kind of changed everything.
They started off with the US small value, and then gradually they started releasing these other products.
As the investment started to grow and the investment community started to respond to those products, we really realized that we had something that was very special there.
I think what really helped launch the firm on a comprehensive way of managing and looking at the entire set of securities was this multi-factor approach.
The thing that the three-factor model is so great about is that it actually breaks down the walls between products, because it essentially makes the total portfolio position relative to these risk and return factors the important decision that an investor has to make.
It takes a little while for it to be intuitive, but once you understand it, it's a very, very powerful tool. It's a very powerful compass. So we, in effect, with that, provide the compass and then the tools to help advisors be successful.
The Fama French research fell on very receptive soil, so to speak, with these advisors. They put up money to start some of the funds. And so that created momentum for Dimensional to really implement the three-factor model.
It was started as very much a small company with a couple of guys getting together. Great idea, build it from there. See what happens. It's enormously successful.
It's like a history tale being told down the line of generations, that there are the initiators here and they get a good idea, and then there are practitioners that practice it, and so on forth down the line. It becomes refined over time.
We weren't actually going out and marketing our services. We were expanding the knowledge of a set of ideas, and if people would find those ideas compelling, then they would seek us out.
The ideas have been there, and the ideas have always been strong and the real underlying drivers, but when it came to implementation, they have not done things until they felt that they had somebody that they felt comfortable with.
The opportunity to plug into sort of the ideas that were coming out of the States that these guys were expounding seemed to me, from a business perspective, to be an awfully good opportunity.
I'd started looking at the achievements of Fama and French and various other people, and somehow it connected, somehow it made so much sense to me, and I felt that there was a need in the Australian marketplace for these type of strategies down here.
It's not so much that we're changing for the world, is that the world changes for us.
And I think that's what's going to happen, not just in Australia, but globally.
Risk has to be related to return in any well-functioning market around the world. And so this combination of empirical data where we have it and this very strong belief allows us to go into a number of these markets.
As long as there are employees that embrace the idea and want to carry the flag to the next level, we will get there.
Diversification, low costs, efficiency of portfolios, those things are recognizable globally. And those types of concepts, the capital market concepts that we talk about, are recognizable globally.
Interestingly enough, the clients themselves may not know they have that need until we've had a discussion with them and we've said, well, what about if we did it this way or that way? And the discussion happens and a sort of small kernel of an idea begins, and that starts to grow and eventually blossoms into a fully blown strategy.
None of Dimensional's products fall very far from the tree. And I think we're very consistent in developing products that still hold on to our basic philosophy, our basic approach to investing.
We're subtly changing things all the time, but it's, you know, it's if it was about movement, you'd have to line yourself up with a telegraph pole to see whether you were moving. But if you come back a year later, you'll see you've moved a fair bit there, little.
We have a portfolio management group, a trading group, a marketing group, the RDs, embracing the idea of developing new products to serve new needs out in the market.
Who knows what the next thing is that, you know, right now that we would have never thought we would have done. But, you know, in the end, if the research is there, you know, to support the idea, you know, who knows? And we don't know where research is going to go. And in some way, that means we don't know where Dimensional is going to go.
When we saw opportunities that made sense, that we was consistent with our set of beliefs, that we thought was scalable, or had some hook as to why we'd want to go to all the effort, if it meets all those things, then we're, you know, we'll, you know, happy to go, you know, go that way.
The firm is extraordinarily principled, and I think a lot of that comes from the backgrounds of some of the people that founded the firm were from the Midwest in the U.S. and they're people.
We are consistent in what we do for our clients, we're consistent in our client focus, and we're consistent in the way that we manage money in terms of that underlying philosophy. And that is very powerful. It doesn't seem very powerful when the rising tide is there, but when the tide falls and the rocks are exposed, all of a sudden it becomes incredibly important.
The beauty of Dimensional is that we have these very firm foundations that we're trying to implement.
If you're talking about how to solve something, it was always bright minds thinking about things rigorously academically. And then the key was you have products that have to be rigorously academically proven, and then you had to implement them, and then you had to sell them.
One thing that you realize very quickly is, while there are a lot of very intelligent people at Dimensional, there are also a lot of very nice people at Dimensional. So it's truly a nice place to come to work every day.
We have a reputation, which maybe is right or wrong, of being particularly bright, and I think that's a rub-off. You know, I don't think necessarily we're all that bright, but because we've been attached to very bright people, you know, you get a little bit of that pixie dust that comes your way.
It's like an all-star team, you know, running around here, the days of the board meetings and stuff like that. So for the people, for the right person, there is no better place.
Everybody respects everybody else. Nobody feels like you got to go to the mat to defend some opinion you're used to hold. It's if somebody comes up with a better idea, if they can convince you that it's a better idea, man, that's great. Let's move on. That's the right way to go.
From a integrity perspective and a brand perspective, advisors look at Dimensional and feel that they're going to get an answer that's been exercised academically and has been well thought out and well debated.
I feel what helped was having worked on the dark side for 10 years in stockbroking, having seen the mistakes, having lived through the stresses, the traumas of what works and what doesn't work, and having been looking for an alternative. So there was just really an ideal time when I came across Dimensional and I could see how robust it was.
It had that kind of I would say, down-home, folksy feel. On the other hand, it was very apparent that the people, though small in number, were all extremely bright.
It's like a small town or even childish kind of simplicity, you know, thinking about what's personally important to people who are participating, what's right, you know, what's the right thing to do, combining common sense with really high-end intellect.
We all know this is going to evolve. It's going to be different 5 or 10 years from now too. We'll have other areas that we don't see.
The whole landscape has been supportive of the dimensional approach to life, which is the object of the exercise at the end of the day is to do the best by the client. This is the investment landscape. This is how we believe one should invest money.
We're really passionate about the investment process that we believe in, the fundamentals that we believe in. We're not coming to market with products that aren't supported by the research and by market data.
There's definitely a strong ethic here for doing the right thing for the customers, and I believe a lot of that just does stem from this very strong belief in these principles in investing, that this is the best way for investors to invest for the long run, looking at the principles that Dimensional uses.
I saw this company that's doing well by doing well for people. So their clients were being very well served, and Dimensional was being well served as well by actually making profits by helping people through innovation.
What I find really stands out is the fact that always the client's interests are put first, and we work as a team, we work together.
Most large institutions are good at selling products, gathering assets, but they're not good at manufacturing. Dimensional that's what we do. That's our focus. You know, we're paranoid about costs. We're going to continue to do the research. I think we are one of, if not the most exemplary manifestation of science brought to investment management. I think we are the first ones to demonstrate the efficacy of that idea. And we've pretty well stuck by that gun all the way along.
That whole approach to thinking about markets, and that you could look at historical returns and see how segments of the market did, that influenced everything we did.
If you think about what we do at Dimensional, what we do is long-term. We're all about long-term. We believe markets, we can trust prices.
If you provide products that help people and you help them do what they want to do, you get satisfaction out of it, and it's also business opportunity. Those two things are quite consistent. So I think that's always been their attitude towards Dimensional, and they are more fervent believers in efficient markets than anybody I know, including me.
What differentiates us is this fundamental belief in markets. To run an index fund, you don't have to really believe anything other than you can track an index and performance. Our belief is that markets sort through risk and return very well. And so we did things differently.